discussing the successful short that I took on this practice account of the S&P 500 that was fueled by negative earnings reports by Microsoft. For context, today is Wednesday, January 25th. As shown here, I entered the trade on January 24th at 12:18 uh, Pacific time. And for context, on this date, market participants were wary of the direction of the market. There were very little clues, and majority of future determination of the direction of the market was going to be determined off of Microsoft quarterly reports, which were reported after the bell on Tuesday, January 24th. As shown here, Microsoft quarterly profit falls 12%, but cloud computing business shows strength. Market reacted negatively to this, resulting in a sell-off in the overnight session of the futures and a early morning sell-off at the market open. We are going to be discussing how I identified this trade, why I believed it was a good one or a good position to establish prior to market close and prior to the earnings being announced, and how this is a strategy of mine that I have established after reading multiple books about economics and lots of catalysts. So let's go right into it. So if you've noticed that I've been inactive on the account here on YouTube, I took some time off to start studying economic trends and catalysts that move the market. After much research, I have determined the best or what works for me is using bonds, treasury yields, and the S&P 500 to make trades betting on the direction of the market. So as I mentioned earlier in the beginning of the video, market sentiment was ultimately indecisive due to the fact that a lot of people were awaiting Microsoft earnings before they could establish a confident opinion on the direction of the market. So majority of the stocks were trading in a consolidation area following a sharp open to the downside. And let's get right into it. So I entered the trade at I entered the trade at 12:18 noon Pacific Standard Time, and the trade was for January 27th expiration, 400 strike put options. I purchased 400 of them, and at the time of this order, the SPY or the S&P 500 future was trading in a tight range, as shown here. And at the exact moment I established the position, the S&P 500 future was trading. The S&P 500 future was trading at about 12:18, about 4,033 and a quarter points. This is the exact area that I took the trade, and I was expecting downside because I was noticed having selling activity, and considering that we were at market close or near the market close, and a lot of people were uncertain, but this seller was very aggressive on his selling position for the S&P 500, which led me to realize that there was a pretty high likelihood that the earnings were going to be negative. Now, combine the heavy selling activity with the 10-year treasury yield hitting demand. There was a buyer on the 10-year treasury yield in this range in the 3.41 area to the 3.42 area. Simultaneously as the seller appeared on the S&P 500, the aggressive buyer appeared on the yield. So taking that into account, that the relationship is inverse, I recognized an opportunity, and which led me to establish this position on put options on the S&P 500 ETF since I did not have access to trade the future directly. So let's look into what happened. Uh, S&P 500 goes right here around this area, spikes because people hear that there was some good news. This was after hour spikes. It spikes about 12 points because people are eager to trade after hearing that Microsoft had a few $1 billion in revenue. But it wasn't until the news settled in that a lot of people realized that their overall revenue, as reflected here, and I quote, or profit, and I quote, falls 12%, which is a very bearish outlook for shareholders. And since the entire market was awaiting this sort of news in order to determine direction, it resulted in a sharp sell off in the overnight session, which led us into the open, 6:30 a.m., opening up in this area. So we can see all the way from 4,047 to the open, opening up at around 3,970 range. And let's talk about the specific plan that I had. So my plan was once the treasury yield hit demand, I would await for a seller to hit the S&P 500 tape, and that is exactly what occurred. So in terms of entry, I identified the entry perfectly in order to support the supply that formed at the end of the session. There was also a 40. There was also a 45-minute supply. There was also supply in the 30-minute charts at the close, which we hit briefly, and then also we see that there was an hour supply zone where the seller was selling. And as the news was announced, we can see right here the price spiked into this area where the seller was, and it resulted in the sharp overnight futures sell off over here that you could see, which ended up over here, all the way into the open, the next session. My plan originally was to enter in this area only if the treasury yield hit demand, which happened in the 4.1 and a half range, and or 3.41 and a half range. And as they established inverse relations, it resulted in spikes in both the yield, or rapid movements and violent moves in the market in both the S&P 500 and the yield. The plan for this trade was to exit at either 3,997, 3,997, or 3,960 on the S&P 500, or if the yield hit 3.482 or 3.508. If I would exit the trade at whichever occurred first. So a brief summary as to how I formulated a plot to exit the S&P 500 short was I noticed that at about 3,983 there was a major buyer, and the reason I ultimately ended up closing my position at market open instead of hoping for a sustained move to the downside, I ultimately closed the position because the market opened inside of 3,983 demand. And for those of you who may be experienced watching this, if you're in short and the market opens in an area of demand and there's a sharp sell off, it's a very bad idea to keep your short position because it's a very high possibility for a reversal because you're trapping market participants, retail market participants that are looking at the move and hoping to get a short term gain on it. So, market opens at 39.83 demand. And what ended up happening was I could have held the position uh, for a sustained move to the downside, an extra about, let's check this out here. I could have held the position for an extra 20-point move to the downside. But what made this trade a good trade was that I followed my plan, and that plan was to exit at the areas of 3,997, 3,987, or 3,960. And the reason I didn't exit 3,997 was because I was in SPY options, which can only be traded during the market hours. And 3,987, I hit my plan, and it was inside a demand zone, and I didn't want to risk the the options expiring worthless, so I sold according to plan. The only way I would have kept these put options for a continued move to the downside is if there was no demand at 39.83 and we made a clean move that tore through that buyer's area, but that didn't happen, so I exited at 39.80. Let me get the 1 minute chart so we can get the exact moment. I exited from these put options at 6:30 at 13 seconds, or 6:30 a.m. 13 seconds, as evidenced by the timestamp. And on the timestamp here, where the S&P 500 was trading at the exact time that I exited my position, that was 6:30 a.m. here. At the point 6:30 a.m. right here, and the S&P 500 in a 1 minute candle traded between 39.88 and 39.83. As you can see here, as I mentioned, there was a 39.83 demand zone, and it bounced here at the open as evidenced by the candle, and that was evidence for me to exit the position and not attempt to hold and get greedy. And this was a phenomenal trade because this was a earnings catalyst trade, and most people would not have known about the bad earnings in Microsoft unless you were on board of directors, but in that case, you're not allowed to trade according to insider trading laws. And me being a 19-year-old high school person, I mean, college person who just graduated high school, I figured it was a pretty good one because I got the same market move that was fueled by people who were on the top seats, uh, overseeing companies, blue chip companies like Microsoft. And yeah, this was a clean one. I really liked the fact that I stayed true to my plan. The plan was to enter when the bonds and the S&P 500 became inverse. That happened. Seller and yield buyer appeared simultaneously, and it resulted in that sell-off. So I'm gonna walk through it again so you can see it before I sign off on here. Uh, 30 minutes. We're gonna go to Tuesday. So I enter the trade at 12:18, just in the final hour of trading, which is in this area, this candle, that area, and I entered at about 40.33, and then I exited out at 39.83, which is a roughly 50-point move that was, again, it was caused by a bad earnings, and not too many participants knew the direction of the market because they were awaiting the earnings, but I recognized the opportunity. I took it. Sellers showing on the S&P 500, buyers showing up on the yield as a safe haven, and I managed my risk, I followed my plan, and it resulted in me purchasing these contracts for about an average of about 2.43 and selling them at an average of 4.948. And as evidence here, it was a $99.9 thousand profit if this were real money. I invested $88,000 on this practice account. Again, I want to emphasize the fact that this is a paper trading account. um, I reset the account to $250,000, in order to practice my strategies. And as you can see here, just shy of $100,000 profit. And yeah, the key highlight was I managed my risk appropriately. I stayed true to my plan, and my plan ended up becoming successful. Again, the plan was to enter when they became inverse, the S&P 500 and the yield, and I followed that plan down for a 50-point move to the downside. And we're gonna follow what SPY opened at because we're not trading the S&P 500 future, we're trading SPY options. At market open, it was at about 395.94. So those put options were approximately 4 points in the money. And these went to a high of, I think, like $6 a contract. But I got rid of them at 4.94. Getting rid of them at 4.94 was a much better trade than being greedy and holding out for $6 a contract, because this hit my trade or my plan, followed my plan exactly, and the plan again. I had three major exits: 3,997, 3,987, and 3,960. And 3,997 was torn apart clean, and then 3,987 was too close to the 3,983 demand zone, and I exited. and and I could have held out to 3,960, and the plan almost followed through, but I didn't feel comfortable holding it because the market opened in a demand zone and I didn't want to get caught in a reversal. So I took my $99,000 profit and stayed true to the plan, and I'm looking for the next trade. Uh, Key lessons learned: make a plan, follow through with it, identify buyers and sellers, uh, understand the options and instruments that you're trading, and just follow the plan and stay in the moment. If you stay in the moment and just react to the market instead of wondering what might happen, what if, indecisiveness. If you just follow what's going on and just react, you're gonna have success. As evidenced by this trade, I didn't follow what everyone was wondering. Everyone was wondering, what if Microsoft earnings are good, it'll go up. What if Microsoft earnings are bad, stock's gonna fall down. I just followed my plan, which was trading purely off of the yield, the S&P 500, and imbalances of supply and demand, which resulted in me identifying opportunity. Again, the opportunity that I identified was on January 24th at 12:18 noon, in the final hour of market trading, and we're going to follow it through for a recap. That was in the final hour of the market trading, which leads us to right about here, right there, 12:18. This is an approximate. I entered here, market close, spike because of optimism, but people realized that the earnings were down, or the profit was down 12%, and it follows in the sharp futures sell off, and I exit here at market open right there for a clean 50-point sell off that was fueled by bad earnings. And these earnings were reported after the market close. I want to put that for the record. And for the record, I entered these options in the final hour of trading, and I followed my plan. I got my plan, stuck with it, and it resulted in just shy of 100 grand, 100,000 US dollars, $99,930 was the exact profit, which roughly translates to about 115% uh, trade on these options. And again, this was a move completely fueled by an earnings report. Not too many people knew about the earnings. Like I mentioned in the video earlier, only board of directors would have known. And yeah, that was the result. 115% on those options when everyone was indecisive about the market. I identified opportunity, followed my plan, capitalized on it, and am looking to do this just react to the market and just go wherever the market goes, because there's no point in trying to predict it. You just got to react to it. If you predict it, you end up being biased, and you get scared in the market, and scared and fear. Usually, it's not a good outcome when you're scared. And yeah, right there, 97,000. And for the camera again, I want to show that I did get in on these puts. Final hour of the session. Cashed out at the open the following day, and was anticipating a negative report on earnings based off of the charts. And I followed my plan. These are the results. Uh, uh like uh, I'm gonna continue these videos and these thought processes and reviews and main lessons. Just get a plan, follow it, and just react to the market. Nothing else. That's it for today. Uh, I'm gonna upload this, and you guys will be able to watch this for those of you that I give access to, and yeah, continue on making these videos. That's it for now, guys. Have a good night. Uh, just keep on reading. Just read the markets. Have a good one. Signing off.